those of you who are not familiar with what we do, we're a not-for-profit. We've been in business for about 10 years now. We do monthly meetups. We fly in speakers to come and educate our community on technology, startups, and just encourage everyone to take a step forward in entrepreneurship, specifically technology. We have about 9,000 members in our membership. It's free to join, and we do have some other member plans if you're interested that have some nice features. So tonight we've got Dividendo.
Hello. So good evening. I'm Matthew Meehan. This is Santiago Maggi. Our company is called Dividendo. We're happy to have the opportunity to present to you tonight. Dividendo's mission is to help you make investing part of your daily routine. Before I tell you a bit about us, we wanted to touch on the theme of tonight, which is Fintech. For us, the most important things about Fintech are increasing transparency, efficiency, and accessibility. And this last one for us is the most important thing that Fintech brings. And it goes to the heart of what Dividendo is about. So one of the things that we think is important is to point out is financial services is a very highly regulated industry. But even regulators are very, very keen on the fact that what Fintech brings is accessibility. So even the Federal Reserve has noted that if technology can bring greater access, that we can provide better results. So what are robo-advisors? It's an automated full-service investment advice, brings you lower costs with no trading fees, usually a much better interface than traditional services. And again, lower account minimums, which for us is the focus of our business. And we think there's a massive opportunity here. One thing to note is that there's been rapid growth in the field of automated financial advice, but there's still very little awareness. So a KPMG study that came out last year showed that 9 in 10 banking customers have never heard of some of the largest providers of this service. When they describe the service, which is low cost, easy to open your account online, fast and easy digital sign up, 8 in 10 responded that yes, this is something that they'd like to have. So for us, it's very powerful because it tells you it's an awareness game. So going back to what we mentioned again on accessibility, usually financial services and wealth management has been something that's seen as a product for people that are wealthy. 50% of Americans don't own any financial assets. In some communities, that ownership is even lower. In the Hispanic community, 85% of Hispanics do not own any financial assets. So we think that's a great opportunity to democratize access to investment advice. So I'll let Santiago tell you about Dividendo.
So with that, we go to what's Dividendo. Dividendo basically it's a micro investing app that will help you to make investing part of your daily routine. Just with $1 per month will provide you with an automated way to save money, small amount of money every single day. How does it work? We believe that our goal is to help as many people as possible to become an investor for just $5. In less than 5 minutes, you're opening your account online. Then we connect your bank to your account to fund your account. Then you can link your debit card, credit card, and every time that you make a transaction, we'll round it up to the nearest dollar. And then those extra cents will invest it in your Dividendo portfolio. When we say that we invest your money, we have a customized, diversified portfolio of stocks and bonds for you. So once that you open your account, you invest all those cents, so we help you to save, and then immediately we have also that those cents that we're saving, you can invest it in your portfolio. We truly believe that the best way to become an investor is to start with small amounts, but in a consistent basis, and that's what we do. So basically, it's where we're standing right now in our project. We just finished developing the software. we built a very complex and sophisticated software from scratch. We're looking to launch our beta phase next month. We are looking to have our mobile app ready in the fourth quarter, and we're looking to do our seed round financing in the fourth quarter of 2016. And obviously, we couldn't talk about this with our team. We have an amazing team helping us in this amazing effort. We have excellent professionals on technology, financing, and obviously marketing. And the most important is that everyone is really excited to make this vision a reality. And that's what we do. Thank you very much. This is what we do. Thank you very much. If you would like to see more information about Dividendo, please visit our website, dividendo.com, and you can sign up for early access to the beta launch in the next month. Thank you very much.
So we're here tonight to welcome Jeff Cain. He's from the Y-Next Accelerator. He's going to talk about the importance of how to select an incubator, an accelerator that's right for you, right? There are so many accelerators and incubators, even just in Miami. Finding the right fit for your company with the right resources, mentors, and the ability to help you grow is really hard. And so tonight we're going to learn a little bit about like how you should go about selecting what accelerators or incubators you should be looking into, some of the qualifications and things you should be keeping an eye out for. I was fortunate enough to go through the Y-Next Accelerator with my company, Envestnet, which is a fintech company that helps accredited and it helps provide a service for crowdfunding websites. So for those of you who are familiar with investing online through crowdfunding, as of 2012, you can invest as an accredited investor for equity in companies. The burden of verifying their status is on the site, and so that's how we came up with our company. We are a COG, we are a required step in all investments for crowdfunding for equity for Title II. So tonight we have Jeff, again, director at Yodlee Incubator, and our moderator, Regine.
Well, we're thrilled you could come out today and talk to us about accelerators and fintech. So what we did earlier, let's take a hand count. How many people here are kind of curious about the incubator accelerator? Okay, and then let's do the fintech folks. How many? Okay, good, because we planned a half and half kind of agenda for today, so that's perfect. And one last question. How many entrepreneurs out there? Wow. Okay, we're inspired. Jeff and I are inspired. We're not entrepreneurs. We're the cogs in the wheels. So my name's Ranjani Chandrakant, and I work for Cassell Salpeter, an investment bank. I focus on technology. We're thrilled to have my friend Jeff join us from the other coast at a corporate incubator. And maybe to kick things off, well, first of all, I have a few prepared questions. Keep your questions in your head. We'll ask very soon in refresh fashion what's on your mind, and we'll open it to questions. But to kick things off, let's ask Jeff a few questions. And so maybe, Jeff, if you could tell us about Yodlee and the incubator program at Yodlee.
Yeah, first of all, I am psyched to go back to Silicon Valley and tell them that the Miami tech scene and entrepreneurial scene is alive and well and banging. I got here yesterday, and I've just met a ton of people. It's been really, really awesome. And this is a huge turnout. This is the same size turnout we would get in a Silicon Valley event like this. So that is great to see. I also want to point out, if Herwig's still here, Peter's co-founder, you can talk to him about the program. And Holly Tishby, who's from our developer evangelism team, is here. If you have deep product questions about Yodlee, do not ask me. I don't know. Ask Holly. She does know.
Where's Holly?
She's waving behind the pillar over there. So Yodlee is a data platform that aggregates consumer and small business financial data from over 15,000 banks and financial institutions. And our customers are banks and startups who want to build applications that get a holistic picture of a consumer or small business's financial information. So if you want to know what is in your customer's Wells Fargo checking account and their B of A mortgage and their Amex card and their Charles Schwab brokerage account, They give you their username and passwords for all of those. Those username and passwords come into the Yodlee system. We reach into those companies' cores, we pull out the data, and we present it. The example that everybody knows is Mint. Mint was built on Yodlee. Then they were acquired by Intuit and switched to Intuit's competing product. So that's the sort of application that uses us. We have 400 bank customers worldwide. We have startups ranging from personal financial managers to alternative lenders to sort of robo-advisors. So that's kind of what we do. We've been around since 1999, which in Silicon Valley means you're basically a mainframe company. You're an abacus. So in 2014, we wanted to get a little bit deeper in innovation, and we started an incubator. And the idea is find entrepreneurs who are doing really cool things with our data and make sure they have the resources they need to bring those things to market and accelerate their growth. And then our salespeople go out and say, look at all the cool stuff you can do with Yodlee data. And that's kind of the game. We don't take equity in the companies. We just want them to succeed. A little detail about the program. It is non-residential, so you don't have to come to Silicon Valley. We found that fintech entrepreneurs skew a little bit older and do not want to move to Silicon Valley and live in a flop house for 3 months. So it is instead a 6-month non-residential program, 3 boot camps in the course of those 6 months. We fly you back to Silicon Valley. We have speakers, we have panels. You sort of learn Startup 101. You get a mentor, you get a bunch of subject matter experts. We give you 12 months free access to our API, up to 1 million active users per month. And we have a demo day at the end with, last demo day, we had something like 55 venture investors, we had 20 bank innovation executives, we had some press, and a bunch of other people who were apparently there for the free lunch. I'm not sure who they were. So that is what we do. I am out here fundamentally drumming up interest. So the applications are open. They close September 15th for a cohort that begins December 5th in Silicon Valley. And the best way to get people to apply to your incubator is to get on the road and come to meetups and come to events like this and say, this is what we do. If you're interested in building anything on Yodlee data, fintech or non-fintech, you should consider applying. Yodlee.com/whatever, you can find it on the website. Our application is up on f6s.com under Why Next, which was a brand that we used last year and was going away. So if you search for Why Next Incubator on F6s, you'll find our application. It's pretty straightforward. I'd encourage you to apply, and obviously I'm here to answer questions.
So Jeff, for our fintech executive entrepreneurs out there, tell us the benefits of staying back here in Miami or wherever you are and networking within, thank you, someone told me to speak closer to the mic. Networking within your industry or spending some time with because it's time off work. So help us with the benefits for your incubator, or if they're looking at someplace else. What are the benefits for the entrepreneur?
Well, our incubator's pretty easy. You're in Silicon Valley for, call it, 10 days plus demo day over the course of 6 months. And frankly, if you're a tech entrepreneur of any type, you should be spending 10 days every 6 months in Silicon Valley regardless. You need to be in the Valley at least sometimes meeting with investors. And since we're going to pay for your plane flight, you come out, you come to our boot camp, and you schedule some meetings on top of it. And we're going to this year, based on user feedback, end our boot camp days at 4 instead of 6, so everyone gets an extra 2 hours to do their job instead of having to do it from 3 to 5 in the morning, which is what they've been doing for the last 2 cohorts. That being said, other programs, more typical residential programs where you would come to San Francisco, 500 startups just launched a new fintech program. I know the guys who run it. One of our graduates is in it. It is a great program. You spend 3 months and you learn an incredible amount of stuff. But you were in San Francisco for 3 months, living. Actually, they're thinking of buying a single residence occupancy hotel to put their entrepreneurs up in the worst corner in all of San Francisco. And you are spending a lot of time listening to lectures instead of doing your work. It is an amazing program, and you'll learn a tremendous amount. But it's also a huge time commitment.
I can see for the corporate incubators, especially your program, as you told me about it, you got to meet with product managers, and it seems like the other, kind of maybe explain the difference between the corporate incubators, getting to meet the product managers, maybe getting some engineering expertise, and the broader ones, the tech startups, the Y Combinators. Yeah,
we are very focused on Yodlee's strategy. Yodlee is a data platform. Helping startups build on your data platform is a classic play. Salesforce has a venture fund, Slack has a venture fund. Our incubator is the same idea, we just don't write checks. So we are focused on getting you up and running on Yodlee, making sure that your implementation works, making sure that it scales, making sure that your UX is as good as it can be. That's kind of what we do. We teach a lot of business skills along the way because we want you to succeed. We teach you how to pitch because we want you to raise money. But we are not a general program in the same way that Techstars or 500 Startups is, where they are taking a variety of people and just sort of accelerating your growth. We are taking a particular type of company, accelerating your growth with half the time, but getting you up and running on Yodlee, making sure you understand where Yodlee's going over the next year so you can adjust your product plans accordingly.
The incubator accelerator phenomenon has just really exploded in the last 5 to 10 years. You can see it in the demo days, you can see it in the pitches, and I'm curious what you think as a Valley person, how do you think it's shaped the startups as they're coming to market?
I mean, I think it's awesome. It used to be that you knew a bunch of VCs in Silicon Valley and you raised money or you shut your business down. There weren't a lot of other options. And now there are. Now, if you're not that entrepreneur who knows the folks at Sequoia and can make the right calls, you can apply to all these programs, and they are much more hands-on, and they will help you, and they will get you to an inflection point, at which point you can hopefully raise money. They'll also cut you a check to sort of fund things along the way. And I'm sure that there are VCs who hate the competition, but the good venture funds aren't hurting for deal flow. So I think for entrepreneurs, it's been a great thing to have all these other options and different things you can do. And whether that is a corporate program like ours, or Citrix had a corporate program, or they just shut it down, FIS and Fiserv have programs, or whether it's a general one like YC or Techstars, or something locally here.
We have many in town. Right?
Yeah, 305 Labs, who we had dinner with last night. The opportunity to do different programs, get resources, and get yourself to the next milestone, I think is great for entrepreneurs.
Yeah. It seems like the VCs like it too, that things are packaged, things are easier to understand, and it's not always who you know now. It can be, you can learn some of that along the way and get to meet the right people. Well, let's switch gears a little bit.
I was going to say, if you come out of Techstars or 500 or one of the well-established programs, or soon ours, yeah, VCs know that there's a certain set of skills that you now know. You spent 3 years learning how to growth hack, and learning how to scale your back end, and learning how to talk to customers and make sure that your product meets customer needs. And so that's, as the VCs say, you've now been de-risked. They don't have to worry that you know how to do that because you learned it at 500.
Conversation
Yeah,
about
they wouldn't have, 500 would not have graduated you if you didn't know how to do that.
Great, that's really helpful, thank you. So let's switch gears so we can get to the fintech questions as well. At Yodlee, you have a great market view, especially as you see the applications and you see how folks at Yodlee are using your product. You have a great market view of what's going on in fintech. So what's exciting right now?
Well, so we're seeing a bunch of trends, and if you read my blog, which you all should, you would know these trends because I wrote about them recently. We're seeing what I call narrowcasting, companies sort of forming to do smaller and smaller things. Instead of lending to small business, I'm going to lend to small businesses I'm going to lend to UPS stores, or I'm going to lend to small businesses with odd numbered addresses. Obviously, those are jokes, but trying to essentially do something smaller and smaller to make customer acquisition costs cheaper and cheaper. That's part of the problem with a lot of these businesses. And whether you are an alternative lender, or a robo-advisor, or a PFM, customer acquisition costs are killing you right now.
For those folks that don't know those cool fintech financial technology acronyms, can you remind us
PFM
what
is
they are?
personal financial management. So it's basically an app that tracks what you're spending.
How many of those are there?
Hundreds of them. There are hundreds of them. So we're seeing people sort of say, I'm going to design my entire company around customer acquisition, and that way it'll be cheaper. And that works until your slice gets so small that your market eventually isn't interesting. So we're sort of tracking that trend and making sure that
For the folks that didn't quite get what focusing on customer acquisition or getting your customer acquisition costs down, maybe you could share a little bit about that.
Like if you're Cabbage, which is a big alternative lender, you're probably paying $1,000 in advertising to acquire a customer who you're lending to at whatever interest rate it is. You're probably not making $1,000 off that customer. If you can reduce that to $500, your margins go up. If you can reduce it to $500 because you are lending to some very targeted market, that's your whole business, then it's cheaper to acquire customers.
So I think that's the bigger trend, not just in fintech, but in technology generally, as we have cloud computing and we can compute on so many things. The cost to create the company is not so expensive, but that cost of customer acquisition, because the market is so noisy with so many new products, is very expensive. And as you see the financials, there's less and less of them, of public companies, SaaS companies, cloud companies that came out. You can see they're all largely unprofitable. The class of, although we don't see so many IPOs anymore, the class of 2013, 2014 high flyers, they're so unprofitable. Why? Cost of customer acquisition. And any of you pitching, when entrepreneurs pitch, that's a question in every investor's mind. What's your cost of customer acquisition? How do you get that down?
The other fintech trend we're seeing is there's this view that millennials are idiots with money. That seems to be this general consensus. All the millennial entrepreneurs who are pitching me are saying that. PricewaterhouseCoopers agrees with a recent study. So we're seeing lots of folks with apps, tools to help millennials manage their money, because the average millennial apparently has no money and doesn't know how to save. I'm not sure if it's true, but it's a huge trend, and we're seeing that. As you may have noticed by my tone, I'm not sure that either of the trends I just mentioned are good. I'm not excited about those trends. They're just out there. A trend I am excited about is we're seeing companies sort of move up the stack of data and data analytics. So Mint was really good at taking your data and presenting it in a useful way. Okay, that's great. It's very, very helpful. That was 10 years ago, though. Now, with big data and machine learning, you're getting much better at not only are we going to present it, we're going to analyze it and do something interesting with that data. And the next step is we're going to predict what's going to happen based on that data, and we're going to make decisions for you so you don't have to. We're not going to tell you, we recommend you do X. The software is just going to do X for you, and you can correct it when it's wrong. And so we're seeing a lot of that. We're particularly focused on the predictive piece, and that's of interest to us. Other things we're looking at across Yodlee and our corporate parent Envestnet, the themes for 2017 are wealth, financial wellness, and data analytics. So those are our trends we're looking at. I'm also particularly interested in folks selling into the wealth management and financial advisor market. Those guys they're being eaten alive by technology, and they don't know how to deal with it. It can be a challenging market to sell to, but they do have money and they need tools. Ditto somewhat with banking. Being the new Jack Henry or Fiserv or FIS is, I think, a good business.
Going for the jugular, for the big core systems. How many people do you see going out for the big core systems, giving them a run for their money?
Right now, almost none. Particularly Silicon Valley VCs in particular are much more interested in funding a consumer app than someone who's going to sell to banks competing against an entrenched enterprise software company.
They're hard.
It's really hard, but that's where the big rewards are.
Yeah. And I don't know how much time you spend in Atlanta, but there seems to be more of the payment processors in Atlanta than in the Valley. Well, great. Let's see. You talked about a little bit of the difficulties getting above the noise, and I guess if your advice to entrepreneurs that are looking, they have this great idea and there's so much competition, what's your, I guess, biggest piece of advice to get above the noise, bring down the cost of customer acquisition? You mentioned narrowing too much is hard.
Yeah, don't get too small. My advice is always find something that you're interested in and continue to push on it and push on it and push on it and see where it takes you. All the interesting companies I talk to are on their first pivot or their second pivot or their third pivot. And they're not full pivots, they're tweaks. They're a 45-degree turn instead of a 90 or 100-degree turn. But they found something that they thought was interesting, and they pushed, and they said, yeah, this is a good market, but what we were doing doesn't really work. We're going to do this other thing. And you just keep pushing, and eventually you come up with something really, really cool that does rise above the noise.
I'm going to give my 2 cents on that one. I would say, for pitching, say refocus. I remember going to a pitch meeting, and the person told me they pivoted 4 times. We had the first pivot, and they kept talking about the pivot, and I'm like, you went in a circle if you pivot like that. So refocusing is critical, right, in those early stages and finding where you're at. Well, great. I have a ton more questions, but I know you have questions out there, so.
So the question is whether machine learning is taking away jobs in wealth management and financial advisors. Not yet, but it will. If you are a financial advisor who doesn't provide a ton of value, you are going to be replaced by software. Absolutely. And so what you're going to see is the not that sophisticated financial advisors go away, and the sophisticated ones are going to continue to have jobs because there are people who need more sophisticated advice. And I'd say that's true, not just in financial advisors, it's kind of true everywhere that software is going to replace humans. Is if what you're doing is rote, you're easy to replace with an algorithm. If what you're doing is pretty sophisticated or incredibly high touch, then you're harder to replace. Crowd lending in commercial rather than consumer. I think there's still a ton of opportunity in lending. There are some challenging economics, finding customers at a normal, a worthwhile price, and frankly, at this point, finding lenders. I was meeting with a very well-known alternative lender that has raised hundreds of millions of dollars in equity, and they are slowing down loan origination because they can't find a source of capital for the lending. They can get equity to grow their business and hire people, but they can't actually lend right now. And so you need to sort of figure that out. And now I'm seeing a bunch of startups that are, it's becoming this two-sided market, and they're juggling. They're going, okay, I've got 15 million from an institution, I'm going to lend that. Hopefully I can do that over a year and get enough origination and some results so that I can convince that same institution or some other institution, give me another 15 million. So it is challenging right now, but everybody knows there's a ton of demand from decent credits for additional lending. The question is, where in a company's life stage do we see them applying to the incubator? We are technically stage agnostic. All we care about is that you are building on the Yodlee platform. The reality is that generally happens pretty early in a company's life cycle. So I would say half of our companies are 2 or 3 entrepreneurs with an idea and a wireframe, and they are just starting to build things. We've also had companies that have been in the market for 2 or 3 years with revenue, and they're doing some sort of revamp of the product that includes Yodlee functionality. I sort of draw the line. Generally, if you've raised an A round of several $1 million, I'm probably not going to let you in and give you our data for free because you should pay for it.
What do incubators expect from startups?
It depends a lot on the incubator. Most incubators, the general packages, they're going to give you $100,000-ish and 3 months of learning, and they're going to take 5 to 7%. That's generally the deal from a good incubator. The incubators that give you $100,000 and then ask you to pay $60,000 of that back in fees are not good incubators, and you should not do that. That is a terrible model. We don't take equity. We also don't give cash. Our model is we're going to give you a bunch of learning and some free software and access to every financial institution in the world if that's relevant, and in return you're going to build on our data platform and talk about how awesome it is.
And that's the big distinction with the corporates, right? That it's a way to promote the product. You get to first look at new technologies. So that's the kind of distinction overall with the corporate incubators.
Generally speaking, a lot of corporate incubators will take equity too. I mean, we could. What we give is worth 5%. We don't because it just doesn't fit our model. We also don't want to compete for deal flow with other incubators, and giving our companies a clean cap table helps us not compete. Yeah, that's if Yodlee still has its own product. We do have a money center product that we support and is fundamentally a test bed. We're not acquiring customers on it. It just sort of sits there and we experiment with it. And amazingly enough, there are something like 40,000 people who still use it. Other than that, we have no direct-to-consumer products. We are building more apps that we are then giving to our customers and sort of saying, we have more data, and so we can kind of do, to some extent, more interesting things, and we might as well hire the PhD data scientist and leverage him or her across a variety of customers. But no, Money Center, it's a great experiment, and people still use it. I'm sure people sign up for it, too. People are crazy.
Jeff, when you see those applications for our entrepreneurs in the room, what does good look like? Like, what do you say, wow, I need to get this one? What does, not a good idea, and maybe a funny one? What was your most funny application?
We have some funny ones. I wear 2 hats. I wear a sort of VC-ish hat, and I'm looking, is this a good business? Are they going after a big market? Does the product make sense? Is their go-to-market strategy smart? Is this a strong team? And then I'm also wearing this Yodlee hat, which is this a really interesting use case? Is this new? Is this something we haven't seen before? Or is it something we've seen before but taking us into a new market? Is this something that my sales guys can point to as really interesting? And our class of 8 companies, we end up kind of doing, it's a portfolio strategy. I'm going to let in 2 companies that are obvious slam dunks that any VC would say, yeah, that's a good investment. I'm going to let in 2 that are maybe not, but really, really interesting, and 4 that are sort of on that spectrum in between.
So that in that application for the darlings, what do they look like? What do they need to have in there?
You know it when you see it. You got to see a big market and someone who's doing something that makes sense. You can just tell.
It's differentiated.
It's differentiated.
The funny one. We want the funny. We want the jokes.
And we had a PFM for couples that was really about, so you don't argue with your wife about money or your husband about money. You put it all into the software and let the software have the difficult discussions.
There's got to be a demand for that.
That you don't want to have.
Did you accept them?
We did not accept them. We had the Bitcoin company that was stoned during their video. Their application wasn't that funny, but their video was very, very funny because these guys
I take
were
it they didn't
baked.
make it?
They did not make it. Just this crazy
So
people.
not stoned during the video.
Yeah, do not get stoned during your application video. It doesn't
More
work
questions.
well. Unless you're a fintech company for the cannabis industry, and then it might make some sense. And we do see those.
Blockchain was the question.
We are not that involved with the blockchain. Again, our data is in consumer and small business accounts, and blockchain tends to be sort of more of a core technology. Folks like Coinbase and other wallet companies could be customers of ours just because they're taking money out of a bank account, and so they need to verify that you actually have the bank account and that you have money in it before they ACH the money out. But in general, no, we're not really looking at blockchain or Bitcoin, other than, I'm in the business and I read the articles, but we don't see companies. Sure. The question is, if we don't take equity, what are we taking, and why would someone go through us? We do not take a percentage of revenue. We don't take anything. What we encourage them to do is be reference customers and talk about how awesome Yodlee is. We then really, I won't say leverage them, because that seems kind of userish. We use them as showcases for interesting things you can do. So that when I have a salesperson out talking to B of A, and she can say, these two guys built this in 6 months. 2 guys, 6 months. B of A, you have 10,000 programmers. You can probably build something that's interesting, powered by Yodlee. I don't think they're actually that mean in these conversations, but I encourage them to be that mean. It is fundamentally a marketing initiative. That's exactly right. Now, when the 12-month free contract is over, assuming that you're still in business, obviously you're going to become a paid customer. So that's a good thing, and some of these companies are going to become giant customers. But that's not really the goal. If that were the goal, I'd let in 30 companies and spend no time with them instead of 8 companies and a lot of time. The reason to do it is, again, it's low touch, so you can sort of stay where you are, you learn a bunch of things, you get free access to our software, you get access to the Yodlee ecosystem. And if you're looking at that versus another program, part of the reason we don't take equity is it's not an either-or decision. You want to do us and then 500? Great, we've had people do that. You want to do us and YC simultaneously? We can make that work too. Mm-hmm.
With several corporates I've seen, it's a little different than Yodlee's model. They get a first look at what's happening. So you may not know all the technology things that are happening by having this ecosystem of people through their accelerators. They can take a look. Same with VC investing or early stage investing within a large company, so they can take a look at a trend.
The question was, why is marketplace lending slowing down? I don't think it's because of regulatory. Lending Club and Prosper sort of worked through all those issues. It is that Lending Club showed the weakness, which is if you're selling loans and you are either lying about those loans or making mistakes in your documentation of those loans, that's kind of a bad thing. Institutional investors are looking for a certain return at a certain level of risk, and they're getting something different. And right now, and this will equalize throughout the rest of this year, everyone's getting hurt by Lending Club. Institutional investors are just going, I'm not sure I trust any of you people. And so Lending Club and Prosper and Avant and all these other folks, they're rebuilding trust. I don't know if they're repricing so much as showing that the pricing was right. So
having more controls, having more.
Control. Yeah, yields are going up on marketplace loans. I think that's as much economy and interest rate environment as anything else. It's more just sort of establishing, when we said we were going to have a 7% default rate, here's the information that backs up that model. They could, but since most incubators are taking 5 to 7%, If you go to 10, you've just given away 50% of your company, and that doesn't seem like a very good idea. It's doubtful that the experience or the press is worth giving away half your company. If there were a bunch of incubators that didn't take any equity, then you could totally do that. And it might be fun. You could travel to Silicon Valley for one, and then Charlotte for the next one, and Little Rock has one. That might be kind of fun. But no, almost all of them take equity, and it just becomes uneconomic.
And if you do have the money and do have the energy and time, I have seen a couple that have been through a couple of incubators. I can think of 3 off the top of my head that have been to different ones. And they got something different from each. One was a sales and marketing one was a pitch one, so they were a bit of a different focus. And so if you're a first-time entrepreneur and you're competing against other folks that have done it 2, 3, 4 times, that might make sense if you have the time and the means for it. I've seen it.
Like many decisions entrepreneurs have to make, it is, should I give up ownership in order to get something? And am I getting something that's worth more than the 5% or 7%, or in the case of a venture round, 25% that I'm giving up? And you just have to gauge that based on your knowledge of your business.
Smaller piece of a bigger pie.
Yeah.
That's the VC investing, time in tech, time in mentoring, or time in incubators, time in mentoring, all this is time and money.
Question is, can you build your company gradually instead of raising $1 jillion? Yes, depending on the market. I mean, if you're Uber, you couldn't do that. You had to be in every city. You had to sort of own the network effect, and you had to spend money hand over fist, and they still are. If you are a product that you can build and get paying customers fairly early, and then you're going to iterate it and say, okay, I've got a few paying customers, and I'm going to make it better and get a few more and a few more and a few more. You can totally do that, unless some company that just raised $100 million in venture money is coming straight after your market, in which case they're going to clobber you. So you tend to see that happening in less competitive markets.
And I think they're a little bit unsung heroes. I know a number of bootstrapped companies that you have never heard of that are making nice livings and doing terrific stuff. So I think they're a little bit of unsung heroes. You're not going to see them in the paper because they're working hard,
and that's my
they're
point.
making money. They're out there.
Yeah,
they're out there.
but they're in markets where they're not getting a ton of press and attracting a bunch of entrepreneurs who say, I'm going to go raise $40 million and own this market in a year and a half.
I worked in the .com era. I worked for a company. The 2 founders were on Fortune's Richest 40, Under 40 in the .com with Jerry Yang, with Oprah Winfrey, with Michael Dell. 2 people. They got 2 spots, 2 brothers, and because they bootstrapped their company and they went out in the bubble. They didn't take any outside money. They took a little right before the IPO. So that you don't see that typically, but it happens.
Atlassian didn't take any venture money, and they're public at a several billion-dollar market cap. It definitely happens, and it can be done, but it does have to be in a market where you can kind of get customers and iterate that way.
Differentiate yourself and tenacity. Oh, thank you. What do we do on a day-to-day basis? Yes, we help. We're a boutique, so we're small. We help companies raise capital, and we help them buy or sell. So M&A advisor for our firm, M&A advisory and private capital raises. So I work for an investment bank in town called Cassell Salpeter. We're 9 professionals. It's a boutique, but I was next door neighbors with Jeff and lived in the Valley for a while and worked for some Valley companies. So companies that I worked for included SonicWall, which is the one that had the 2 richest 40 under 40 in the .com bubble. I worked for Neo Terrace, which was a Jim Clark NEA-backed company that got bought by NetScreen, that got bought by Juniper Networks. I worked for Lehman Brothers for a moment. May it rest in peace. I worked for Sun. Okay, this is a fun story. My office was on the front page of the Wall Street Journal with weeds growing around it. I said, why is my office on the front page of the Journal? It's home of Facebook now. And they still, on the other side of the sign, have the face. There's a thumb up on the sign. On the other side, it's got a Sun logo on it. So good for them to keep that.
An area I'm really interested in, and talking to a lot of companies, is what I call the new factoring. You've got sort of all these folks, Joey and Luigi, who are lending to businesses against POs and invoices, and it's fragmented and paper-based and mildly scary and very, very expensive. And you can do the same thing that you're doing to other pieces of lending to that. the question is going to be, can you actually price the risk better, or are you just undercutting Luigi because you have venture money, and how does that play out? There's a company in LA called Produce Pay that's doing this. They're essentially factoring for farmers. They're also kind of hedging the commodity price simultaneously. Super interesting. I tried to convince them to apply. They were already raising money. But I'm talking to a number of companies doing the new factoring. I think that's really interesting. Not yet. It will be.
There seems like a huge opportunity because there's so many individual businesses like farmers and truckers, and they go to get really unfavorable terms to get, it takes a while before you get paid, right? So there's a float. If somebody could figure that out electronically, somebody's going to make a buck, and a trucker would probably, a farmer would be a little bit happier.
Yeah, I knew a gal once who had a company selling nutrition bars for pregnant women. And she got into Whole Foods. And Whole Foods takes a while to pay you. And you've got this invoice, and Whole Foods is a great credit, but you are sitting there waiting for that cash to come in. In the meantime, you're paying your manufacturer to make the next shipment. Classic kind of small business selling a big business problem. And there are folks who will lend against that at 35% or 40%. And so it's just a question of doing that faster and cheaper.
Good idea. Let's all go back and be inspired with some ideas. Thank you, everyone, for your time today.
Thank you all. Appreciate it. I'll stick around for a little while if you have questions.
Cool. Thank you. I actually have one for you, and an interesting fintech trend that we've been seeing as far as our new customers. Think of like a traditional business who does financing for a product, let's say mattresses or furniture. Traditionally, the business would finance that. Internally, or have and so what we've been seeing as our customers is they open 506c plans, which is allows accredited investors to do backs, and so they put the money in, and then they use that money to finance the loan. So, for example, one of our biggest customers, Lending Home, raised $100 million, and their biggest mission is to effectively second mortgages, things like that. They back them, and then accredited investors then pay for those, buy into those mortgages and distribute across. So it's an interesting business. If I had money and I could turn a key, that would be something I would build. Turnkey solution for traditional businesses to replace their financial loans with 506c money. Cool.
All right. Thanks.